Hello, everybody. This is Tortoise Investing coming at you today with three more dividend stocks that you can buy and hold forever. If you're new, please hit that subscribe button. I greatly appreciate it. Drop a like. Those two things help me out tremendously. It's super free and easy to do, and I can't thank you all enough. We're at 631 subs currently, and let's just keep marching toward 1,000. It's so awesome. I want to grow this into something great. But yeah, none of this is financial advice. Just do your own research and stuff before you buy anything. Showing you some stocks I think that are pretty good prices right now currently. But yeah, let's go ahead and take a look at S&P Global, Darden, I hope I'm saying it right, restaurants, and realty income. Starting out with S&P Global, they recently had a high of 428 down to 359. I really, really like this company. This is if out of everything that I've went over, this and Home Depot are the two stocks that I would love to add to my portfolio. Like, seriously, if I had the funds, I would buy them now. Just a free cash flow yield of 2.62%, got a dividend yield of 1%, payout ratio 49%. Revenue's been growing at a rate of 13% over the last 5 years. This is very nice. Free cash flow, 5.84% over the last 5 years. Over the last 10 years, rate of 14.48%. Again, very nice. Stock-based compensation is not an issue with this company. That's what this is. As you can see, they're not, you're not getting diluted, and they are putting their money to good use. EPS has been growing at a rate of 12% over the last 5 years. Again, just very nice. Just like a rocket straight up. Love it. Their debt, they usually don't carry a lot of debt. It's at $10 billion right now. EBITDA is $4 billion. It's still within my boundaries of what I like. I don't like a company to have three times their EBITDA or more in debt. And when you take a look at the quarterly here, this is something that they're paying down slowly but surely. So I think that they'll just get this right back in order. And with the shares outstanding, they issued back more shares because they did an acquisition, but they are already buying shares back. They went from 339 million to 319 million, so they've already bought back around 20 million shares, which is just awesome. Love it. I love when a company does that. It returns equity to us, the shareholders. We get a bigger and bigger piece of the pie. Love it. The dividend's been increased at a rate of 12% over the last 10 years. Their last hike was a smaller one, I think right a little bit over 5%. But again, they did that acquisition and stuff, and that's going to make it to where the future is going to be a lot brighter with this company. We're gonna be getting a lot more bang for our buck. I feel, personal opinion. Return on capital employed, very reliably in like the 30s. You had this dip here, and then this dip here. The reason this dip was here is because they had to issue out more shares for the acquisition, but pretty reliably in the 30s area. Gross margin, super high, 60s and 70s. Operating margin, again, reliably super high, climbing, 40s and 50% here. And the profit margin, it's just crazy how much money this company makes, 20-30%. But yeah, S&P Global might be something you want to look into. Next up, Darden Restaurant. Their big thing is their Olive Gardens, and I just had some Olive Garden the other day with the wife, and it was great. Love that place a lot. They are off their highs of 172 as of July 20th, and it's dropped down. I think that Ozempic weight loss drug thing has scared a lot of these food companies. Hershey's dipped because of it. I've been buying me some Hershey, but this also fell. McDonald's fell because of that. Might be a buying opportunity. Adjusted free cash flow yield of 4.96%. We got a dividend yield 3.76%. Payout ratio 61.44%. We have to refresh on this, see if free cash flow shows up. Yeah, it does. Okay. Revenue's been increased at a rate of 5.35% over the last 5 years. Very nice. They had a little hiccup there of COVID and afterwards, but it looks like it's right back off to the races. Free cash flow, 13% over the last 10 years. Very nice. Again, up and to the right. Like to see it. Again, stock-based compensation is not an issue with this company. EPS been growing at a rate of 9.8% over the last 10 years. Again, the 2020 hiccup, a lot of companies had that, especially restaurants had to shut down, were hit hard during COVID. The cash to debt, let's go ahead and look at this quarterly. Right now they have 1.48 billion in debt, and their EBITDA as of this year is 1.57 billion. So no issue there. Beautiful financial balance sheet. Like it a lot. Dividend's been increasing at a rate of 10.3% over the last 10 years. They had to slash it during COVID, but as you see here, after things got settled out, they put it right back to where it was and have been increasing it ever since. So I don't know, I like it. Pretty good company. Shares outstanding, they have been buying back shares here as of late. As you see here, over the last 2 years, they rated 3.44%, going from 131 million to 122 million shares outstanding. So yeah, again, another thing I like to see a company doing. Now the return on capital employed, as you can see here, had the 2020 dip. They're in the recovery year, but looks like it's right back 14.4%. The market average is around 10. So again, I really like this company. They're usually above that line. Gross margins, pretty good, around 20%. Operating margins, yep, 9 to 12%. That is also pretty good. And profit margins is 8 to 9%. So again, pretty dang good. And lastly, we're going to be taking a look at Realty Income. A lot of people love this company. A lot is down hard this year. Interest rates being higher for longer are scaring a lot of people out of real estate. And I'm buying extra space storage like crazy right now. This is another one. Like, if this keeps dipping, it's just going to get to the point where it's just ridiculous. Just a free cash flow yield of 8.17%. Dividend yield over 6%. Crazy. Revenue, 21% over the last 10 years. Free cash flow, 22% on average over the last 10 years. Very nice. They carry a lot of debt. That's just what REITs do. 15 billion. EBITDA was right at 2.9. So, I mean, it's honestly not that bad for a real estate investment trust. Usually their leverage is even more than that. The thing a lot of people love this company is it pays monthly and it increases its dividend every quarter. And it's usually a smaller one, but over the last 10 years, right at 4% increase in that dividend. And it's just been ticking like clockwork right along. Great, amazing. Now, REITs do issue shares out. Their shares out. They either do acquisitions with debt or shares, and this company usually issues out shares to do acquisitions and stuff. Don't know if profit margins, operating margin. Oh yeah, I've never actually looked at these. So operating margins, pretty good, 30s, 40s, 50s area usually, and profit margins are also pretty good, right around 30s and 20s area usually. So yeah, pretty good as well. Those are 3 dividend-paying companies, 2 stocks and a REIT that you can buy and hold forever. Again, always do your own research stuff before buying anything. I greatly appreciate it. And until next time, see yous.